know,
Sorry.
and you all of know Mr. Ramdev Agarwal has been very generously sharing all of his knowledge with the investors through the last 26 years. And why I say 26 years is because it was back in 95, December of 95, that he wrote his first wealth creation study. And while he has grown 1000x between 95 and today, the dedication and the commitment to do the pilgrimage of, sparing 1 month to write this report is something that he has not stopped. Like most of us do our Tirth Yatras annually, I think his Tirth Yatra is investing, and he has been doing that very religiously. And everything that he has written and the summary of that is available on Motilal Oswal WCS. WCS stands for Wealth Creation Studies. And for those of you who haven't gone through all of that, you may find it very exciting to see how the journey has evolved, because it's like seeing a child grow up to an adult, and the same maturity in investment thought process is what we have kind of tried to share with investors. So that's a little background. What I'll do today is divide my presentation into 3 parts. The first is about economy, markets, and how should one look at this, because all of us have seen 12,000 Nifty on 1st of Jan 2000, right? We saw 8,000 Nifty in March of 2020, 1st of Jan 2020, 12,000, and then 8,000. And then we saw 18,000 recently, and we are at 17,000 today. So everybody is kind of really asking me these questions about, should one be worried about the markets? Should one really stay back? And all of these questions keep coming in mind. And the more you are equipped with data, the more you are equipped with knowledge, I think these things become excitement rather than a source of worry for you, right? So today my objective is to simplify this whole thing and share with you, some of our thought processes based on looking at the Indian economy, based on looking at the corporate sector, based on looking at the markets. So I'll launch myself into the presentation. Feel free to stop me if you have any questions. If you have any questions, and you need more clarification on any of the concepts. So let me start with my favorite exhibit. Okay. So basically, we believe that stocks are slaves of earnings. So if earnings do well, if businesses do well, then stocks will do well. And if earnings do badly or businesses do badly, then stocks will do badly in the long run. In the short run, market could be a voting machine. In the long run, it is a weighing machine. You really can't hide anything from your weighing scale. You can't really hide anything from the markets. True earnings will reflect in long-term wealth creation through stocks, right? So basically, what is it? What does corporate profit to GDP mean? It means that, let's say, India's largest company by profits is, let's say, Reliance Industries. So you take Reliance Industries and go all the way down to the smallest company and total the profits of all of these companies. Okay, so that's the corporate profit of Indian corporate sector, right? Now, divide that by the GDP. GDP is really the economy. I mean, these companies are operating in the Indian economy. So corporate profit to GDP is a good measure of the profitability of Indian corporate sector. So this corporate profit to GDP, now you see that I've divided this chart into 3 colored bars. The blue bars, which is one part of history that we have lived. The yellow bars, which is another part of the history that we have lived. And then the gray and green bars, which is what is unfolding right now. And at this point in time, I'd like to introduce a quote by Mark Twain that history may not repeat itself, but it surely does rhyme. And what I would request to you, Jaspreet and Preet, is that my colleague Senthil will share with you an article that I have written on this, which draws 7 parallels between where we are now and another point in time in the history of the Indian markets. So I will present a few data points in our presentation today, but a lot more data points are available in that article, which you can share with all the participants today, so that they'll be able to understand what I'm going to present in a lot more detail with a lot more numbers. So basically, corporate profits were 2% of the GDP in 2002. And they went up all the way to 8% of the GDP. Now, what does this mean? What this means is that a lot of businesses were doing badly in 2002 and they started doing better in 2008 over a period of time gradually. So banking sector was doing badly here. Banking sector started doing better here. Telecom companies were doing badly here. They started doing better here. Commodity companies were doing badly here. They started doing better here. Over a period of time, gradually, their profitability improved. And this was one of the best periods of wealth creation in the Indian stock markets. Okay. Nifty was at 1100 points here. The same Nifty that we are talking about in terms of 17, 18,000 was 1100 points here. And it was 6,300 points here. A 6 times increase in the entire nation's wealth in space of 6 years, meaning all India promoters, all India investors collectively became richer by 33% per annum for the 6-year time period. Very rare, very unusual. And then what followed was that the same businesses which were doing very well in terms of profitability started doing badly, and the corporate profit to GDP came down from 8% to 2%. And this was a time period. I talked about Nifty going up from 1100 to 6,300 points here, which is a return of 33% per annum. In the following decade, more than a decade, we had Nifty go up by 5% per annum during this time period. Right? So not a great period. I believe that what is unfolding in front of us now over the next 6 years, and we have lived 2 out of those 6 years already, what is unfolding in front of us is the 2002 to 2008 corporate profit cycle. And because we believe stocks are slaves of earnings, we believe that stocks will behave similar in terms of return potential in the cycle like they delivered in the previous cycle. So we started once again our journey back to square one at 2% corporate profit to GDP. We were looking at a number of 2.7% corporate profit to GDP this year, but it's likely to be more than 3% now. And you know what is happening here? Commodity companies were going bankrupt here. SR Gujarat changed hands, Bhushan changed hands. Now you have commodity companies making tons of profits. Telecom companies are taking tariff hikes. Corporate lenders like SBI, Axis and ICICI, which reported losses here, are reporting big profits here. 3,000 to 6,000 crores of profits in December quarter by these companies in a single quarter, right? So IT companies are booming like never before. They used to grow at 4-5%. Now they are growing at 15-20%, some of them at 30%. And their engineers, IT engineers, are getting salary hikes of 20, 30, 40% every year, right? So really, it's the start of a new cycle, a new corporate profit cycle, which can take the corporate profit up to anywhere between 6 to 8%, very similar to the cycle that we saw here. Correct? Now, so this is the most important really slide. Basically, you believe that stocks are slaves of earnings. So if earnings do well over a period of time, then stocks will do well. They will follow suit. And earnings did badly in the last decade. Wealth creation was weak in the last decade. Now, a lot of people are worried about the fact that 12,000 Nifty has already become 17,000 in the last 2 years, January 2020 onwards. But look at what is happening to Nifty profits. Nifty profits used to be 3.6 lakh crores in March 20. And it took a full decade for this profit to double from 1.9 lakh crores to 3.6 lakh crores. And we are now looking at this 3.6 lakh crores doubling in a space of 3 years to 7 lakh crores. So how much is Nifty up? When it goes up from 12,000 to 17,000, that's up 5,000 points or 40%. And how much are corporate profits likely to be up? 100%. So when people tell you stocks are expensive, you should show them this chart. You should say that corporate profitability is at its bottom. So valuations will appear to be high. In reality, they are actually low, because as your corporate profit to GDP gets adjusted to normalized levels, your valuation will start looking attractive. But you can't buy then, you have to buy now. Otherwise, it will be too late. Prices would have already discounted the earnings growth. Now, this is the other thing that is very unusual. I've divided this last 20 plus years into red parts and green parts. What do they mean? So there are two phases of the corporate life cycle. When corporate profits do badly, correct, which means that, so in 2007, 97 to 2003, they grew by 3.5% per annum. What happened to Nifty? It grew by 0.2%. So it got derated. You got punished by a derating of 3.3% per annum. Subsequent period, corporate profits grew at 25% per annum. From a punishment of 3.3, you got a gift of 12.1% per annum. That's called PE re-rating. Re-rating is like a blessing, right? And derating is like a shrap. When corporate profits are weak, you get the curse of derating. When corporate profits are strong, you get the blessing of re-rating. So we got cursed by derating again between 9 and 20, where earnings growth was 6%, which is weak, and markets gave you a return of 5% per annum. We believe that we are in that phase of blessing where strong corporate profit growth led by reset of corporate profit to GDP from 2% to 6 to 8% will get you the gift of re-rating this time. Okay. Now, there are a few big parts of the economy. What is the economy? So all of you know that housing sector is one of the biggest parts of the economy, right? Real estate, housing, offices, malls, etc., etc. Now, you know, last decade has been a lost decade, not just for the stock markets, but also for the real estate sector. So this is HDFC, which is India's largest mortgage company, publishes affordability of homes, meaning the price of homes on an average divided by your monthly income. So how many months of income do you need to buy a house on an average? This had gone up to as high as 58 months and is now down to a 20-year low of 27, 28 months, which basically means that it is extremely affordable for a household to buy a new home now. And what COVID has done is it's created the need for one more room in everybody's house. Many of the IT engineers will be working from home. Many of the companies may continue to have partial work from home, which basically means that you will need more space in your house. More importantly, mortgage rates, you must be seeing all the banks advertising 6%, 6.5%. These are the lowest mortgage rates. States are offering you stamp duty waivers, and builders want to clear the inventory and come out of the mess. So basically, we think that the largest part of the economy, which is housing, is set to do very well in the next 5 years' time. Which doesn't mean I'm recommending real estate to you. I'm talking about volumes of housing will do well. Pricing may or may not do well, but volumes will pick up because it's more affordable to buy a home now than it has ever been in the last 20 years. So this is one part of the economy that should do well. And that, what does this mean? Cement companies will do well, steel companies will do well, lenders to mortgage finance will do well. Kajaria Ceramics, which makes ceramics and the largest company, will do well. Green Panel, Green Lamp, which makes laminates and plywood, will do well. Voltas, which does supplies. So many companies will do well when this does well, right? Second, the second important part of the economy is investments. Investment in roads, in ports, in factories, etc., etc. So look at what has happened to the capex cycle. Capex cycle was in a big boom between 2002 to 2008. We saw a big down cycle since then, and we now expect, all of you have heard of production linked incentive, PLI scheme of the government. 3 to 4 lakh crores have been committed to be spent in a defined amount of time to take advantage of that. We want to make in India. We want to substitute our imports from China, and we want to start making India an export hub. Last 10 years, the air conditioning that you bought in your house, right? The mobile phone that you bought, the laptop that you bought, all electronics that you bought were basically imported, mostly from China. Next decade, when you're buying these products, the Apple, the Samsung phone, the laptops, etc., most likely some of them or a lot of them will be made in India. That is what will drive the capital formation or the investment cycle. And we expect that credit growth, which had slowed down dramatically, as you can see on your screen here, to near negligible levels from 20% plus is set to go up. So these are two big components of the economy. The housing sector I showed you here, the investment cycle which I showed you here, the credit cycle that I showed you here. And so when all of these, so there are many factors like this, and that's why I'll ask my colleague to share with you my full article. It'll give you 7 such other evidence. I'm not going to cover all 7 today, otherwise it'll take me a full hour to do that. But basically, this is what happened to Nifty from 2002 to 2008. Showed you this time period 2002 to 2008. And now look at this 2002 to 2008. Stocks are really slaves of earnings. As corporate profit went up from 2% to 3% to 4%, 5%, 6, 7, 8, markets kept on climbing, right? But I want to remind you that an exciting journey of wealth creation in the stock markets is won by only those investors who have the patience, who have the wherewithal, who have the behavioral strength to stand when the markets are correcting. In this 6-year time period, friends, there were 7 corrections. The red portions that you see on your screen, there were 7 corrections of double digit. And 2 of those corrections were of the order of 30%. Did you run away from the markets, left the market here? Here Nifty was at 1500. Then you missed your 4x. Did you run away from the markets here? Here Nifty was at 2700. Then you missed this whole cycle. So basically, buy right and sit tight. See, when do you get worried about your stocks? When you own low quality companies. When you own a high quality company and the stock falls, you get excited by the prospect or the opportunity to buy more. But when you own a bad company, you get worried that, oh my God, my free ride is over, I got to run. Right? Why do we want you or investors to stay in quality stocks? It's like choosing your business partner. You'd always want a business partner to be a good guy. You'd want your business to be a good business. Then why would you like your stock to not have good management and good business? Correct? That will give you the wherewithal, the endurance to be able to sit through these falls. So basically, as I said, history may not repeat itself, it does rhyme. I feel that what started in Jan 2020 is similar to this cycle of Jan 2002. Where you are in this cycle, you are in roughly Jan 2004 here, which is where Nifty was at about 1500 points. So 17,000 points is the equivalent of 1500, 1600 points here. And so what is in store for you in equities, Indian equities over the next 5 years is a 4x from here. Like you saw 1500 go to 6,300, you can see your 17,000 go up to whatever that number is. So the runway is long, the tailwinds of corporate profitability are strong, and you got to be buying right and sitting tight through this period to really make the most of this journey of wealth creation. No journey is without drawdowns. This is the last 20 years. Show me 1 year where there was no drawdown in the markets, and drawdowns could be as deep as 65%. And a 10-20% drawdown is par for course. It happens every single year. It's like saying that I've got a beautiful German car. I'm not going to ride because there are potholes on the road. Good cars have the ability to give you lower bumps. Good stocks, quality portfolios have the ability to give you lower bumps. And you can have a nice joyride. During this time period, if you just did buy right, sit tight and bought a dumb index, I'm not talking about a good manager, a dumb index, you made 15% return despite all these drawdowns. Right? So this is the first part of my presentation, really. I'm going to stop here. If you guys have any questions on this, or I can complete my presentation and accumulate all the questions and answer them collectively.
Sure, sir. I think we can do the later part. We can complete the presentation and then we can have all the Q&As.
Fabulous. Okay. So turning to Motilal Oswal Asset Management. So really 1995, Ramdevji visited Omaha, met his guru, which is Warren Buffett, and decided that this life is meant for quality investing. So it's now 26 years. We are in 2022. This is our model. Please buy. Think of it like a funnel, right? At the top of the funnel is quality of business and quality of management. What do you mean by quality of business? A good quality business has little bad times. A bad quality business has a lot of bad times, right? But we have a lot of metrics to define what is quality of business, quality of management. Ramdev actually put together a book where all the 25 investment frameworks that are used to understand what is quality of business, quality of management, etc., etc. All these frameworks are published and available on Amazon, Flipkart, everywhere. For those of you who are interested, please do consider, making an investment in that book. It may be better than making an investment in many of the stocks. Okay. Second, you can buy the best quality company and the best quality management. But growth is life in stock market. So if you don't have growth, then you will not make a lot of money. You will not beat the index for sure. Third, we don't want to be on a treadmill where we are running and we are there all throughout our life in terms of our wealth. Right? I don't want to find a new partner, a new business every day or a new stock. I want longevity of these two factors. Meaning I want a runway where I can buy, right, sit tight for the next 5 years, 10 years on those stocks. And lastly, they say what love is to life. This is Van Dan Berg, a great guy who made this quote. What love is to life, price is to investing. Life without love means nothing. And investing with a wrong price will get you nowhere. So you have to pay a reasonable price. So you think of this like a chair. A chair has 4 legs. The 4 legs are QGLP. You cannot use the chair if any leg is broken.
Prakash?
You cannot really reach your goal of wealth creation if any of these 4 factors are missing. Now, we've gone through our journey of wealth creation and ups and downs, and all of you are aware, funds do well, funds do badly. We always reflect back every year by year on what have we done right, what have we done wrong, and what are the learnings for us. So 2 of the important processes that we've instituted, all of you would have heard of post-mortem in life, right? Post-mortem is after an event analysis of what went wrong, correct? Today at Motilal Oswal Asset Management, if you have to buy any new stock, we have a 25-member investment team. We sit in a room 9:30 a.m. to 1:30 every Monday and Thursday. So 8 hours, you're locked up in a room. And what we do is these 2 things. Pre-mortem, meaning any new idea that we want to buy, we have to do a deep dive where anybody who wants to buy presents it to the entire team. What that does is that if any of the 25 members have gone through an experience with that management, with that business, know the competition, know the supplier, where something is wrong, we should know about that before we buy, not after we buy. So pre-mortem rather than post-mortem. And the next is cross-pollination. So whenever we like an idea as a team, it need not be bought in one portfolio. We can buy it in multiple portfolios, back up the truck, load the truck, basically cross-pollination of those ideas. The second important thing that we do is we've got a standardized portfolio monitoring template in the same QGLP format, where quality of business, growth, longevity, price is measured in number terms, so that I get an outcome, an output of what is the expected return on each of my portfolios for the next 3 years. Our philosophy is that if our earnings double in the next 3 to 4 years' time, then stocks are slaves of earnings. The portfolio will double in the next 3 to 4 years' time. And if you broadly achieve that, then you're home. And all of this is reviewed with the portfolio managers on a fortnightly basis, right? Now, I talked about the wealth creation studies. This is the QGLP checklist where we have presented all the 25 frameworks and the 25 questions that you should ask a management. And these are some of the very interesting studies. This was written in December of 2007, as you can see, 14th of December 2007. It's called the Next $1 Trillion Opportunity. I'm going to present this today in the last part of my presentation. And then this is a study which was done, as you can see, in December 2015. And it's called Mid to Mega. a dream of every investor to buy a mid-sized company that will become a mega-sized company. What's the investment process to get there, right? We have always believed, even before Taleb wrote this book called Skin in the Game, and before SEBI came up with the Skin in the Game guidelines, that we should invest 100% of our money where our clients' money is invested. So at this point in time, Motilal Oswal Group owns 4,225 crores of its own funds. This is our money in the PMS, AIF, and mutual funds that our clients buy. So we will only win if you win. So that's the end of my second part of the presentation, which is about the AMC. Now, turning to these two studies that I spoke about, and we're very excited about this study. While it was done in December of 2007, friends, the most relevance of this study is from the year 2020 to 2030, in my view. So let me explain what this means. So Ramdevji was very excited in December 2007, right, somewhere here, when India, from 1947 to 2007, took 60 years to touch the first $1 trillion of GDP. 60 साल लगे हमें पहला $1 trillion GDP बनाने में. And at this point in time, the study published this chart which said that every subsequent $1 trillion will get added not in 60 years but fewer and fewer years. And this growth in GDP will present very many multi-bagger, exponential, non-linear opportunities in the stock market. So this is when we launched a fund, December of 2007. We did the study and immediately launched a fund called the Next $1 Trillion Opportunity Product, NTDOP, right? Where this journey of every $1 trillion addition in lesser and lesser number of years, we thought the basic expenditure of a household, roti, kapda, makan, will not go up much. You can't eat a lot more. You can't wear 2x the number of clothing, etc., etc. So the basic expenditures will not go up much, but discretionary spends will grow 10x when India goes through this journey of every $1 trillion being added faster. Savings and investment will grow faster. So now, what are the examples? When you double your per capita income, where are the 10x opportunities? So for instance, people want to buy a better house. People want to buy more consumer durables. If you have one AC in your home, you'll want to buy AC for every single room. You will want to upgrade from two-wheeler to four-wheeler. If you have Maruti, you will want a German car. You will want to spend on entertainment. You'll going to theaters, holidays through travel, premium clothing, etc., etc. And similarly, invest in mutual funds, insurance companies, build the infrastructure of the company, capital goods. So a whole bunch of opportunities in these two spaces is what we want to focus on in terms of wealth creation. So what this fund has really done is between June 2009 and December 2021, investing through this philosophy, it has compounded money at 21%. Since inception, it has given an excess return over the benchmark of 5% per annum, courtesy these non-linear opportunities. So Page makes undergarments by the name Jockey, bought in December 7, still a part of the portfolio to some extent. Money multiplied 77 times versus the first purchase. Bajaj Finance was bought when it was nearly a bankrupt company, and change of management and infusion of capital was required in August 10. It sold in April 20, made about 58x. Eicher Motors bought when Siddharth Lal was appointed as the CEO of the company, and they relaunched their iconic Royal Enfield bike, multiplied money 23x. Bought this company which makes Horlicks called GlaxoSmithKline Consumer, became Hindustan Unilever, 18x, and so on and so forth. And at this point in time, as I speak to you, we continue to make new purchases where we think the same magic can be repeated even in the future. So basically, the 5-year rolling return history of this 14-year-old fund is to generate a 21.5% return per annum compared to benchmark return of 11.5% or nearly 10% excess return. Each portfolio goes through this Agni Pariksha of what is the QGLP stack. And here's the QGLP stack. The fund invests roughly 50% in large cap, 50% in small and mid caps, reasonably well diversified across all themes which can present non-linear opportunities. We expect return on equity of this portfolio to be 20%. profits to double in the next 3 years or grow at 24% per annum. Longevity of each of the companies is very strong, and it trades at valuations which are substantial discount to the market. So if you do a comparison of, so this is what we do for all the portfolios. What is the portfolio return on equity? Is it far superior compared to the benchmark, which is NSE 500? What is the EPS growth of the portfolio? And is it better than the benchmark? And what is the PEG? PEG is defined as the historical PE divided by the next 3 years EPS growth. Basically, lower the better. Lower the PEG, the more chances you'll make higher returns. So basically, the PEG of the portfolio is far superior. It is basically much lower. You're paying a lower price for a superior quality in terms of ROE and a superior growth portfolio. So if we believe that if you construct a portfolio which has superiority across all the three parameters, then there is no reason to believe it cannot outperform over the longer term. The fund has come back very strongly after every crisis. It was up 117% in the year ending March 2010, which is a 27% outperformance. Likewise, post-Asian currency crisis, the fund was up by 130%, generating huge outperformances. We believe that post-COVID pandemic is a very similar time in life. The other product, the focused mid-cap strategy, was launched by us only in December 19. It's up by 118% during this 2-year life compared to 96% increase in benchmark when most of the funds have really underperformed the benchmark, courtesy a lot of multi-baggers that have been added to the portfolio, which have generated anywhere between 3 to 10x return. Here again, the QGLP stack is very clearly established, and we believe that the risk reward is very favorable. Finally, I'll come to the last theme, which is the mid to mega study that we did back in December 2015. Basically, you can divide all companies listed in India in 3 buckets. Mega companies are those which are ranked by market cap from 1 to 100, where extensive research is available on each of these companies, and prices often discount a lot of the future fundamentals. Mid-sized companies are ranked 101 to 300 by market cap. They are relatively under-researched and under-owned. And finally, mini companies are those which have ranked from 301 onwards. For the purposes of this product, we've chosen to restrict ourselves to rank 301 to 400 companies. And the idea is really to understand how the companies move from this bucket on the right side bucket to the middle bucket, or from the middle bucket to the left bucket, because that is the most exciting journey of wealth creation. So this is a study I spoke about, December 2015. It's available on our Motilal Oswal WCS website. But basically, when you have a confluence of an industry leader, even in a small segment, industry tailwind, meaning something favorable happening to the sector, and within that, a value migration beneficiary, when you have this golden triangle being available, right, we believe that a crossover by a company from mid-sized company to mega-sized company, achievement of critical mass and scale, and recognition by the stock markets of the same is something that plays out. More details are available in this study, but basically, we have to look at crossovers from a 300 to 400 rank to 100 to 300 rank, or from 100 to 300 rank to the top 100 ranks. And when you do something like this on a rolling 5-year basis, we believe that you can roughly spot anywhere between 10 to 20 names on an annual basis of these type of companies. And these companies have a track record of generating a 38% compounded return compared to benchmark of 12%, meaning reasonably strong outperformance, obviously supported by stronger profit growth and stronger return on equity. So basically, the same QGLP philosophy really is deployed to focusing on rank 101 to rank 400 companies. So anywhere between 200 and 300 companies, where you run all the other levers that you traditionally run, but start with a small size. Now, if you look at the examples of history, all of you may be aware of this company called Muthoot Finance, which is the market leader in gold finance. They were ranked 175 when they qualified for the mid to mega transition, went on to break into the ranks of the top 100 companies, became the 80th rank by market cap. And this 5-year period from March 15 to March 20 led to 100 rupees invested in the stock becoming 296 versus 100 rupee invested in benchmark becoming 94. Similarly, Eicher Motors I spoke about moved from a rank of 128 to rank 38 from March 13 to March 18. And during this time period, 100 rupee invested in this stock became 959, while 100 rupee invested in the benchmark became 238. There are tons of examples like this. I can show you about a 50 slides on this, but I'm going to just stick to a few names. Motherson Sumi, which is an auto parts company, went on from a rank 130 to 48, and 100 rupee invested became 674, while benchmark was 191. So basically, this table that I showed you, where returns on these companies, where you can spot a transition from a mini 301 to 400 rank company to a mid-sized company, or from a mid-sized company to a mega-sized company, typically you see very, very strong performances. These are just some evidences of that. And basically, when you roll all of this in an AIF structure, I want to share with you, this is something which is not well understood. Because we run a large private equity business, what we have tried to do through these AIFs is to draw down the money gradually. A drawdown structure allows us to time the market based on individual stock prices, whether they are right, market correction, whether it is there, and get the money when the price is right, so that we can add the behavioral alpha, which may be difficult for the investors to manage themselves. Similarly, the idea is not to run this portfolio on a perennial or a perpetuity basis, but have a framework to sell and an option to return partial money or even mature the fund earlier. And this allows you the manager alpha, so that you can actually lock into the gains that you've collected. And finally, the AIF platform offers us the best of both the PMS and mutual fund in terms of flexibility in stock and sector selection, which mutual funds may constrain you, and the execution of a pool account, which is what mutual funds offer you and PMS does not offer you. So all the three alphas collectively can work in your favor. So I'm going to stop here, and I've shared with you how I think about the markets. I've shared with you how Motilal Oswal's philosophy of QGLP has been honed over a period of time, and deploying it into investment frameworks, which is next $1 trillion opportunity and mid to mega. I'm happy to take any questions that all of you may have at this point in time. Thank you very much for your patient hearing.
Thank you so much, sir. I think a lot of very interesting and informative data which you have shared. So I have few questions, and then we'll open it for the audience as well. So anybody, yeah, of course, you can raise your hands. One thing which comes to my mind is you talked about pre-mortem of the ideas, right? So analyzing it with the 25 members team. Does it still go wrong?
So like day and night are kind of very integral part of the life.
Right.
Downturns and upturns in the stock market are very integral part of life. Losses and gains are very integral part. Making mistakes are the blessing or the foundation on which you become a great investor. I'd be lying if I tell you that we don't make mistakes. We just try to ensure that we don't repeat the same mistake over and over again. So when we make a mistake, I'll tell you what one thing we do differently. The moment we make a mistake, we channelize that back into our wealth creation studies. So let me give you an example. I showed you the slide of QGLP, where there were 4 legs to the stool: quality, growth, longevity, price. Now, Motilal Oswal used to manage 500 crores of AUM. And in a space of 7 years, because we were generating 10-15% alpha every year, guess what happened? There was a big FOMO among investors, and they poured a lot of money into our funds. And 500 crores became 50,000 crores in 6 years' time.
Okay. Wow.
Now, what happens is when you believe in buy right, sit tight, you're basically holding the same stocks, right? But one of the legs of the chair got broken, which is the P leg. Right. So we went back to the laboratory. We went back to our wealth creation studies and said, let's do a deep dive into this. What should be the Lakshman Rekha for P? And we came up with a scientific framework for our managers, for our investment team, that if the PEG, let me repeat, what is the PEG? PEG today for any company or for the markets is March 21 PE divided by the next 3 years EPS growth. So let's say if the PE is 40, and if the next 3 years EPS growth is 40, then the PG is 1 time.
Yeah.
But there's another company where P is 40, but the EPS growth is 20. So the PG is 2 times, not 1 time. So the PG is 2 times more expensive compared to the first company. So the first company is better compared to the second company, assuming that they're meeting the QGL criteria, both of them.
Right.
So we drew Lakshman Rekha, and let me share with you what is the Lakshman Rekha, because we published it. The Lakshman Rekha for a portfolio is 2 times, meaning even if you give me 5,000 crores, I will make sure that I will not let the PEG cross 2 times, that Lakshman Rekha. What happens when Sita crosses Lakshman Rekha? You all have read Ramayana, you know that. Similarly, when a fund manager crosses this 2 times PEG for a portfolio or 3 times PEG for a stock, then it is equivalent of Sita crossing Lakshman Rekha.
Great, sir.
So every time you make a mistake, you go back to the laboratory, work on it. For instance, I bought a company where business was great, the growth was great, and I trusted the management. So again, go back to the drawing board, see what are the management filters I got to use, what are the additional filters I apply. So every time that you make a mistake, if you're adding more filters, your tomorrow becomes better than yesterday. Now, what did Ramdevji do in his 26th wealth creation study? The whole study is about how to understand digital businesses. What are the frameworks to deploy that? It's a new subject. For the first time, we have companies getting listed. Should we be scared of them because they are reporting losses? Should we say they are non-QGLP because they are reporting losses? Amazon reported losses from 2000 to 2020. Yeah. From $5 billion market cap to $2 trillion market cap, that company reported a loss. So is that a non-QGLP company?
Right.
So this is the kind of, either it is excitement of something new that makes us go back to the laboratory, or a mistake that makes us go back to the laboratory. You have to keep going back there. Mr. Ramdev Agarwal may be 62 years old and 26 years of wealth creation study. But the childlike enthusiasm when he makes a mistake or finds an opportunity is the same as my 12-year-old son. No difference.
Right. So I think it's a big takeaway for all of us that yes, it is okay to make the mistakes, but not to repeat them. So go back to the laboratory and whatever we are doing in our businesses as well. So that's absolutely okay. I think that is one takeaway we can all take, and obviously in terms of the stocks as well. So my second question is related to some of the SMBs have been holding their investments to make into their capex investments and expanding their businesses and all that. So what would be your take? Because they were because of the pandemic, things were not going well, and obviously they have been trying to survive rather than looking for growth. So what would be your suggestion, because you interact with so many CEOs across the country and maybe the globe as well? So what would be your take or advice to them? Obviously it will be very specific to their businesses, but how do you really see 5 to 7 years next?
Yeah. So, when you're driving a car, you cannot drive looking at the rear view. You have to look at the front screen.
Yeah, that's right.
And when you are investing in business or investing in stocks, what the economy has done in the last 5 years, or stock markets have done in the last 5 years, is equivalent of driving looking at the rear view. You have to look at the future. We believe that the best time to invest is in a downturn. The best time to slow down your investments is in an upturn. Most people do the reverse. As the businesses do better and you make more and more money, they will become more and more aggressive in terms of investments. At Motilal Oswal, we believe that we should be most aggressive in investing in a downturn, and we should be most conservative in investing in an upturn. Right? So when corporate profit to GDP is closer to 2%, you got to show that aggression as a businessman, as an SME or a large business. And when corporate profit to GDP is at closer to 8%, you got to be scared. There's a lot of euphoria. There's a time to leave the party,
right,
collect cash, reduce debt. This is the time to make the investment, show the courage, because the runway for the next 5 years is very strong. So if I'm an entrepreneur, I would be very aggressively building rather than scared of what happened in the last 5 years.
Right. Great. Thank you, sir. So we are going to open it for our audience now, and obviously, as I said, you can raise your hands, and then Ravinderji, so we'll start with you. Please go ahead. Thanks.
Good morning, Mr. Agarwal. Thank you so
Good
much.
morning.
Very nice presentation.
Thank
In fact,
you.
my question you already answered partly, that about the PEGs. Like you spoke about the 4 legs, and my main concern was related to price. See, when the market is so high, like as a layman, like maybe you have the scientific data and everything, but we feel now it's not the right time to enter. But like how still you get opportunities to get a better P ratio, and is it better to go through say mutual funds or through a professional, or to buy it directly from the market? So what do you recommend them? Like we get scared, like when the market is too high, we feel now it's like it's not the right time. We keep waiting, and maybe we do it in a stagger way, or what is the right strategy for that?
Yeah. See, so there are 2 parts to your questions. Let me answer the first part first. So basically, markets are at a lifetime high, right? Say at 18,000, they were at a lifetime high. But do you know that India's largest car company stock price was 6,800 rupees 1 month back, compared to 11,000 rupees 5 years back? So you're getting that company at a 40% lower price compared to its price 5 years back.
Okay.
Right? And there are many such exciting opportunities of market leaders. I'm talking about the biggest and the best companies in India. So in every market, right, when there is euphoria in one part of the market, there's a sale going on in another part of the market. You just have to align yourself with where there is sale, provided it meets QGL. Correct? So today, if you look at the 2 calendar years, 2020 and 21, 3 sectors got very badly impacted. Autos, what happened to autos? If all of us are sitting at home, will you replace your car or your 2-wheeler? No. So today, India is selling 20% lower number of cars and 30% lower number of 2-wheelers compared to what they were selling 4 years back. But we will buy them, right? There will be a pent-up demand. Likewise, insurance companies paid COVID claims of 7,500 crores when the second wave led to a lot of mortality. Premium incomes have gone up forever, but claims were one-off. So you have HDFC Life trading at a lower price than it was trading at 3 years back. So is this a great time to buy? Because they will earn more premiums in the future, but they will not pay you claims. There will not be COVID deaths again and again. So lot of great, I mean, I can give you lots of examples, and that's where I believe that if common cold requires your doctor, family doctor, right? How many doctors do you have in your region? Hundreds. How many great investors do you have? Very few.
Very few.
आप एक बार मेडिकल खुद ट्राई कर लेना गूगल करके, बट इन्वेस्टिंग खुद से ट्राई करना बहुत खतरनाक है.
Yeah, makes sense. So one more question I mean, that's regarding AIF. Supposing for a smaller investor, like supposing somebody has a portfolio of say 1 CR, 2 CR only, or whatever little. So does it make sense to try something like AIF, or it should be like we should split it and into different, I mean, you said that AIF has got so many advantages. So is it risky also to get into that kind of?
So I'll tell you what AIF will do for you in our case is that when you're buying a mutual fund or a PMS,
Navin sir, we lost you.
Yes, okay. That was, you'll have to make a call of entry and exit, right? Here, there's one difference. I showed you that cycle, right? 2002 to 2008 cycle may be repeating now. And we may be in the first 2 years and another 4 to 5 years are ahead. The purpose of launching these AIFs is within this cycle to return the money back to you, which you by yourself may not be able to do. In fact, you may be ending up buying at the peak.
Right.
You know, they say that professional investors water their roses and cut their weeds. Non-professional investors water their weeds and cut their roses. जैसे ही प्रॉफिट बनता है वो शेयर को बेच देते हैं, जब नुकसान होता है उसको संभाल के रखते हैं. You should water your roses and cut your weeds.
Interesting. Yeah. Thank you so much.
Thank you.
Thank you. Thank you. Yeah, Yogesh, please go ahead. Yeah.
Thanks, Navin ji. It was an awesome presentation, mind-boggling. I had listened to your last presentation with ICICI Direct also about the budget and also about the patience earlier, how one has to have patience. I have registered with you, but though I have not started business with you, but I am amazed by the expertise that you have. So my question is very simple. When you talked about the value migration analysis from the mini to the medium size and medium size to that, so what are the factors that you consider? Because that is one of the, because I was a big question mark when you say value migration analysis. It being a technocrat, I have some assumptions about it because everybody has a different connotation when it comes to value, and you are talking about value migration analysis performance. Yeah,
that's a great question. In fact, I'd see, whenever you talk to people like us, we will give you a lot of homework. So let me give you some homework. There is a book by Adrian Slowsky, Adrian Slowzky.
Sir, please again repeat.
Adrian Slowsky, okay, Adrian Slowsky, called Value Migration. So we have been actually very inspired by that book. And let me give you an example, because when you read a book, a great book, it's like a great framework that you acquired, which you then deploy when you find a stock like that. So I'll explain this value migration to you. So when we saw HDFC Bank was born in India many years back, 30 years plus back, we saw the service of PSU banks was very poor. And here came a new generation bank. And you know, banking is a very big sector, right? 100 lakh crores of credit, 135, 140 lakh crores of deposits. It's a very big sector, right, in the economy. We thought that this tiny little thing has a huge runway where value can migrate from PSU banks to private sector banks. So they started what is called corporate salary accounts when PSU banks were not focusing on that. They started focusing on the liability side. They started focusing on credit cards. All the highly profitable parts of the banking sector, they started focusing on. Correct? And if you see the value creation in PSU banks, I should call it value destruction. That is really the migration from PSUs to private sector banks. Today, India's top banks by market cap are all private sector banks. 20 years back, number 1 to 10 were all PSU banks. And these are such beautiful concepts that you can actually generate. It's like, you know, Saudi has these oil fields, right, where you can keep taking out oil for the next 20 years. These value migration themes are where you can keep taking out returns for the next 20 years. कोई जल्दी नहीं आपको, बैठे रहो उस पे जब तक value migration आपको दिख रहा है, हो रहा है. So there are many such value migration. So globally, for instance, value is migrating from offline businesses to digital businesses. Right? So if you can catch a few such value migration themes, right, we thought that value will migrate from the traditional 100cc bikes to the premium bikes because of the aspiration, which is when we bought Royal Enfield. And for 7-8 years, we could multiply our money by 30-40 times. You know, when Bharti launched their mobile phones, you can't believe I and Ramdev were sitting in a room and Sunil Bharti Mittal was talking on that call. I'm talking about 20 years back. Right? And the stock price, the company IPO'd at 45 rupees, the stock price came down to 20 rupees. And we realized that value will migrate from fixed line, jahan pe aapki ghanti bajti hai phone pe, to mobile phones. We could multiply our money 60 times in 5 years. So there are so many exciting value migration examples. Adrian's given quite a few of them there. We have covered it in our investment frameworks. All of this is available on our website also. Please do take a look, but this is one of the most powerful investment frameworks that we have come across in our lives.
awesome. Thanks a lot, sir. Thanks a lot.
Thank you. Thank you, Yogesh, for asking this wonderful question. And, I've shared that link on the chat box as well. It's Amazon link. So maybe you can just go and have a look at the book. But these are very, very interesting concepts. I think they'll really add a lot of value in terms of thinking that what kind of businesses we should also get in as small and medium businesses. So thank you, Yogesh, and thanks for explaining it so beautifully, sir. Anuj, so Anuj is also a CPA based out of Toronto. So a student of, equities, I guess. So yeah, Anuj, please go ahead.
Yeah, thank you, Jaspreet, and thank you so much, Navin sir, for this wonderful presentation. Really fortunate to attend this in such a close gathering. So I have two questions. So from your presentation, I can sense that you are very bullish, and and you have given all the reasons for being bullish about the Indian markets for next 5, 6, 7 years. So what are the major known risks that you see which can derail this? And second question I have is, how do you see cryptocurrencies as an investment option?
Yeah. So as I said, stocks are slaves of earnings. So the biggest thing that can permanently derail it is, or for longer term perspective derail it, is earnings itself. Correct? Everything else is noise which will not derail it but will provide you an opportunity. So for instance, US Fed tightening by 4 times in the calendar year 2022, correct? And withdrawal of liquidity or unwinding of the Fed balance sheet, correct? Where they will sell their securities and suck out cash rather than buying the securities and giving cash. So the reverse gear can cause a correction in the markets. But think of it from a global perspective now, just for a moment, that somebody's gain is somebody's loss, right? So if some of those tech companies, high growth companies there see redemptions, the money will have to go somewhere, right? Could it be emerging markets? Because emerging markets had a loss last decade, right? So basically, I believe that any geopolitical issue, any tightening related hiccup, right? Each of these can cause corrections. But the real core why we come to the stock markets is to back great businesses run by great managers who will actually prosper despite adversity, right? That is why we come to the markets. Coming to crypto, see, these are newer concepts. Nobody understands them yet. Most of them who are participating in it are participating because the rare view returns look spectacular. It takes a lot of time to understand these concepts. I am a great believer in the concept of blockchain, and it will transform the financial services sector. However, one of the use cases of blockchain is crypto, and really the jury is still out on how this will shape up. We have extremely wise people, far wiser than me, who are predicting demise of this, and there are enough smart people who are forecasting that this is the real future. I really don't have a very strong view, and that's why I would avoid. So you know what, if you want to really reach a century mark in cricket, you have to avoid a lot of balls. This is one of the balls I'd like to avoid.
Beautiful. Yeah. Beautiful. Outside of stump. Yeah, let it go.
Yes, yes. I'll caught behind ho jayenge sir isme.
Beautiful. Right, great. Thank you so much, sir. So wonderfully explained. I think Anuj, that really helps. And not only to you, I think you asked a relevant question, which was probably going through in all of our minds as well. So very, very beautiful way of letting it go, because we don't really understand it well yet. Yeah. Thanks. So we'll go to another Anuj. Yeah, Anuj. So today Anuj is joining BANC. It's his first meeting, and I'm so glad that he's learning as well. So Anuj, please, over to you.
Thank you, and this is a great learning today from Navin ji. Hearing it from a veteran himself. One of the questions I wanted to ask was about cryptos. He answered it beautifully, and I let this ball go. Not be caught behind. My second question is that we've been working hard all our lives. The fear or the lack of knowledge of these financial markets and everything has not let us invest in in the stock markets. So as a person who really wants to start doing this right now, what would be the best piece of advice you would like to give? so that my money starts working harder than I've worked, in my past years. So where is that starting point? Because with so many people in the market, it's very difficult whom to trust. Everybody claims, and then we've seen stories of all people rising up and falling down. So where is the sweet spot?
Yeah, great question. So I want to let out a secret firstly with all of you. The secret is that whatever businesses that you may be running as entrepreneurs, right? You work for a certain number of hours. Let's say you're employed by someone and you work for a certain number of hours, right? Your business or your profession can earn you, let's say, X at the end of your life, right? If you start investing early, then that X could become 10X. Because you can only work 9 to 5 if you're very hardworking, from 8 to 8, 5 days a week if you're very hardworking, 6 days a week. Your money can work 24/7. And while you may have heard the word magic of compounding many times, right? Very few people understand that 1 plus R raised to T, everybody's focused on making more returns on their portfolio. But the magic is created by T. Buffett is what he is because he is 92 and he started it in his teens, right? He has invested for a longer period of time than the age of most of us on the call today. So the T that he has applied is the magic, correct? So by starting to invest early, if you realize it today, it's still not too late. But just ensure that your money is working for you every day. Now, let me let out the second secret. And this is one of my really, really favorite authors, Nick Murray, NICKMURRAY. He's written a book which is so short that if today Saturday, it's now 10:45. If you start reading it at 11 a.m., you'll probably finish it by the evening and you can go out. Such a short book. It's called Simple Wealth, Inevitable Wealth. Simple Wealth, Inevitable Wealth. It will clarify a lot of your fundamentals for life. He is one of the most expensive and one of the best wealth managers in America. He doesn't write articles. He doesn't put out YouTube videos because he's a great guy. He's a very expensive guy, but he does bless us by writing a few books here and there. And we ensure that we read all of those books and read them many times so that we understand what he's trying to say. It's a must read for all of you. But basically, a poor person should never buy equities because he consumes out of his income or if he has any savings. If your income is greater than your expenditure, then you should not buy a rupee of fixed income or deposits. Let me explain this to you. Longer term, 20 years, 40 years, 100 years, America, India, Europe, anywhere, equities is the best performing asset class. I have a lot of articles, charts. I can share all of that with all of you, right? So longer term equities does better, right? So if your income is in excess of your expenditure, that means your income, your savings pool, volatility does not matter to you, right? What is the problem with equities? While they give you superior returns, they are volatile. If you are a rich person, then volatility in your wealth is okay as long as longer term outcomes or returns are superior. If you are not going to consume out of your wealth, then that wealth should be in equities. If you're going to consume out of your wealth, then that wealth should be in fixed income. Otherwise, your consumption will get impacted. That's why a poor person should never invest in equities. A rich person should never invest in fixed income. Nick says, be an owner, never be a loaner. Loaner means fixed income. Owner means equities, right? So basically, that's the first part. The second part is that, yeah, now whom to back, right? really most often one will go to the descending order of returns chart and buy the best performing manager. We have a study for the last 25 years which will show you that any manager who's best performing for any 3-year period will be roughly the worst performing for the next 3-year period. So if you bought the best performing for the last 3 years, you would probably bought the worst performing for the next 3 years without knowing it, but effectively history stacked up against you. So basically it's important to buy right, sit tight, meaning whatever you buy, suppose you bought the best performing for the last 3 years and becomes the worst performing for the next year. That's also okay. But then stick to it, because then there'll be another 3 good years also. Over a long period of time, let's say I showed you NTDOP. Okay, NTDOP has generated post fees 5% extra return. Now markets themselves have given you a 15% compounded return, right? If you can get 5% extra return, that's even more. Correct? So why would you not allow the magic of compounding through that? So, I mean, if I were to leave you with a recommendation, depending on the corpus, if one wants to invest less than 50 lakhs, then I'd strongly recommend large and mid cap fund of Motilal Oswal. You can buy any alternate fund of any other asset manager. Perfectly fine to do that. My job is to tell you where I have the highest conviction within my portfolio. So the Lmc Fund, which is a large and mid cap fund, is the best performing in this category. On a 1-year basis, I think that can continue at least for the next 2-3 years. So that's one portfolio. NTDOP within the PMS and the mid to mega within AIF. So there are options. It really depends on your risk appetite. Multi-cap funds will have a lower risk metric compared to a small and mid-cap fund. And risk is not defined as permanent capital loss. That's actually stupid or foolish. It is risk is defined as volatility. Mid-caps, so small children can grow faster, high speed can lead to more accidents, mid-cap can lead to more volatility. It's very simple, like truths of life.
Great. Thank you. Thank you, Anuj, for a wonderful question. I think that would also have answered some of our members as well.
Thank you so much.
We will take 2 more questions, sir. And
sorry, Jaspreet, can I interrupt? It's not a question, but it's very interesting. Like what you said, Mr. Agarwal, now that mostly the consultant, whenever they come, they give you last 3 years performance, and on that basis only you end up buying like whatever investment you are doing.
Actually, so, I'll give all of you this chart which proves that last 3 years maybe the worst of the next 3 years. So every time somebody comes and does that to you, you should show them that chart and ask them कि भाई इसमें क्या गलती है हमें बताइएगा. तो वो आपको अगले बार से वैसे नहीं करेंगे.
Get it. Thank you so much.
Yeah, sure. Yeah, Sudeep, please go ahead. Atul ji, आपके पास अभी आ रहे हैं इसके बाद. Yeah, please, Sudeep.
Yeah, sir. Thank you. Standing ovation to you. Standing ovation to Jaspreet sir for getting this right. I have been reading Ramdev sir books and buying it to write on the margins. And the moment you gave this book link, you know, Ramdev ji sir has somewhere mentioned this book. I immediately jumped to buy, and it was 12,000 rupees. Let me tell you, it is not available in a Kindle copy. It's a hard copy, so it still lies on my aspiration stage. Right now, sir, I have right there are we are seeing a lot of pre-IPO. The share of profitful of technology stocks in India is around 13%, vis-a-vis to when we see in China and US, it is around 40%. Most of the companies who are coming for pre-IPO are from the technology background. There is a lot of semiconductors, which is India lagging, and there are a lot of PLCs which has been announced. And there is a lot of alternative power like ethanol and all, which will remove petroleum. I feel, right, that's what the people are saying. So can you recommend at first any book which talks on Indian economy, vis-a-vis to relation with an international economies, and how most talks about company and stock investing, but something which is on the Indian economy, point one. And point two, what's your view on this pre-IPO like Byju's and Misho and all this lining up? Right. And third thing, sir, is retail investor. I have been retail investor first, and I feel it is an entertainment industry. You see the metrics every day. You go high, you go low, and at the end you lose. Rather than shit tight means you forget it, and you don't see the analytics and you don't enjoy it. Right. So that's what my views to you. Yes, sir.
Yeah. So on the second part, which is pre-IPOs, the longer a company is listed, the more you know the history. Right, the lesser a company is listed, and some of these companies are very newborn, right? So once again, it will require a lot more hard work, lot more analysis, and they also have to be proven. So they have to go through their Agni Pariksha of a downturn. They haven't yet seen one, right? So my recommendation would be, again, this is a ball that we don't understand fully, let it pass. You will get your opportunity in these names. There will be a time when the music will stop, and from 1 becoming 2 billion and 2 billion becoming 4 billion and 4 billion becoming 20 billion in a short span of time, right? Which is really, these Cinderella tales will come to an end someday. So I think you keep some cash so that day you have the money to be able to buy them, because many of them will be wonderful businesses available at a throwaway price. So that's the second part. As far as the economy, Indian economy versus the global economy, actually one of the things that Ramdevji did 20 years back or 25 years back was that he started, and all of you can consider doing that if you really want to understand how the world is moving and how India is moving. Basically, reading taking a subscription of online version of Financial Times and reading that for half an hour every day will make you a wiser person in the long term. It's just a small investment nowadays with the online copies. You can really buy it at a much lower cost, and you give it 15 minutes, 30 minutes, depending on the time that you have in the evening or the weekend. But you will start becoming better. See, this is like, knowledge is something that really accumulates over a period of time. It's like wealth. Wealth and knowledge have a lot of similarities. So you will have to drop by drop. You really can't over consume it. You tell me I'll spend 12 hours and do it. Really, you may not remember anything at the end of the day. So let it be a slow burn process, and you will really find that you become a wiser person after 5 years. Give it some time, and over a period of time, you'll find yourself connecting the dots and things starting to make sense a lot more to you than it may be making right now.
Great. Thank you, sir. So we'll take a final question, and then maybe we can wrap up. I know we have already extended our time, but yeah, Atul Prabhuji, please go ahead.
Yes, hello, Agarwalji. I have this question which Ravinderji also asked. Supposing somebody has 1 crore or 2 crores, then there are 3 options mainly. One is the AIF option, one is the PMS option, one is the mutual fund option, one is shares option, and the property market. So as my accounts are with Motilal Oswal, my large cap, mid cap investments are with Motilal, but still now supposing I have 1 crore, now where one should be invested? I have been told that the problem with AIF is that you're investing all your money at one go, so you're not able to average out the market. Suppose the market goes down tomorrow or after 6 months, after 1 year, so averaging is not possible. But in the course of mutual funds, that averaging is possible if you're investing it on a monthly basis. So you can ride that dips and like that, but that is not possible with the AIFs or the PMS. So again, my question is that what is somebody who has 1 crore or 2 crores, AIF, PMS, mutual funds, or property market or share market? As a person who doesn't have the knowledge, what should we do?
So actually, we got this feedback that you gave, and that's exactly what we worked upon. So let's say if 1 crore is the ticket size in AIF, you really have 2 options to invest. One is you can do a systematic investment where you invest 10 lakhs per month in that AIF, option number 1. And option number 2, that 10 lakhs per month will be randomness, meaning it may be it may be a low price, it may be a high price, or whatever else, right? What we do is, I talked about the behavioral alpha, manager alpha. So let's say that I have identified 4 stocks to buy in that AIF, and there's a crash in the markets. There's a big fall in the markets last few days, right? And those 4 stocks correct by 20%. We draw down that money and then invest it immediately. So we will be able to add more value than randomly choosing date. I mean, stock markets are not so kind that on the 1st of every month they make a new low because the SIPs hit the account that day. Yeah. They may be making new highs on that day. So basically, these AIFs are designed to add that alpha, the manager alpha, which you cannot do by yourself, because you're buying a bouquet of flowers or stocks, right? And so you can pick and choose those depending on how the prices are on the day of the. So the objective of AIF is to add that market timing element which is ideally meant for professional investors. We would not recommend lay investors to try their hand at it, because often, on an average, they would take away or detract value through those decisions. It's like a layman trying surgery, right? Often, it will end in a disaster.
So in that case, are you suggesting the AIF compared to PMS and mutual funds?
Yeah, I would suggest AIF, but mutual funds is mainly, I would say, a vehicle where there are more regulations, there are more compromises in terms of returns. But if you are a smaller investor with a less than 50 lakh ticket size, then that's your only alternative. I think ticket size is what differentiates it more than anything else.
Great.
Thank you. Thanks, Agarwalji.
Thank you. I think thank you everybody. And if I have this permission, I just wanted to play a very small video of one of the award-winning videos of Motilal Oswal, which I really liked, and it talks about very interesting stuff. So, sir, just 1 second, and then maybe we'll just wrap up. This is just to give a view to everybody.
Screen not visible.
So, sorry, please. So I really love this, and I thought I'll play this for the benefit of everybody. Sir talked about the surgery thing. So great. So I really loved it, and I thought it was really it was a very bankable video to play. So on behalf of everybody at Bank, sir, thank you so much, and thank you to the Money Masters team, the entire support team, for facilitating this session. I'm sure all of us would have really got something and which we can take away and start to implement in our business as well as our personal lives and investments as well. So thank you so much. Anything you want us to, as a parting note, anything you want us to take away?
Jaspreet, we need to take a pic.
Yeah, of course, I'll take a picture as well. Thanks for your
So thank you all. It's never too late to start investing. But I think this is really a journey. Wherever you start, just make sure that you try and understand the importance of quality. Everything that you buy in your real life, personal life, it is amplified as far as the markets are concerned, because this is a matter of wealth creation. And personally, me, Ramdevji, we've all always been 100% invested in the stock markets every single day of our life. So really the biggest secret of whatever wealth creation we've managed is this full commitment to investing through the ups and downs, and not just ups. So really, if you can buy right, sit tight, allow the magic of compounding to play out, then each one of you will be surprised by that X becoming 10X at the end of your life. It can really work as much as 10 of you by the end of your life. So really start beginning that journey, commence that journey, I would say as soon as you can and as much as you can, and also spread this knowledge, I think, among everybody that you know, particularly your loved ones, your dear ones.
Thank you so much, sir. And thank you, Shivam. Thank you, Senthil, sir. Thanks for all the effort behind the scenes to make it possible. And thank you, everybody, for joining Bank's 100th meeting today. We are also laying the bricks one by one, and will continue to grow. So as we always say, stay bankable, bank on each other, bank on yourself, and 10X is coming soon. So thank you so much. Have a lovely weekend, and take care. Yeah.
Thank you. All the best, everybody. Good luck. Bye.
Thank you.
Take care.
Senthil, sir, in case you can share some of the links which Navin sir has mentioned.
Yeah, I'm doing that. I'm planning to, coming to Delhi second week of February.
Sure.
And we can also have a client meeting.
Sure. And a preferred list of books or any articles that if you would like to share, you know, Anuj,
I'll get it shared to all of you.
yeah, and Anuj, you know, just mentioned that he was trying to follow or connect with you on LinkedIn. So I don't know if you are there or not, so that we can read and follow on that whatever you are saying. That also be.
No, Motilal also on AMC itself, has a separate LinkedIn profile. So that has got the complete update of Sir's update, Ramdev Sir's update, and every update has been put in there.
Please do share that as well. I'll circulate within our community also.
Yeah, I'm ready with doing it.
Right. Great. Thank you, sir. Thank you so much. Thank you, everybody. Enjoy.
All the best. Good luck.
Thank you.
Thank you.